The job is not quite done. A direct quote from Fed Chair Jay Powell as he indicated a March interest rate cut is unlikely. So what's next for the FOMC and what could it mean for your investments? We'll break it all down for you right here on UBS Trending. Hi again, everyone. I'm Anthony Pastore. Welcome to UBS Trending. Leslie Falconio is back with me to break down the latest moves within the fixed income markets related to the comments from the Federal Reserve and Jay Powell. So, Leslie, always good to be with you. I want to start with the recent Fed meeting. It seemed a bit hawkish from Powell and the team. And this was certainly exemplified then by sort of a very strong jobs number that came out afterwards, because the Fed is always looking to see what's the health and strength of the economy, how is it measured by jobs, et cetera, et cetera. So what right now is the CIO's take and the outlook on where the Fed goes from here?
Well, we really haven't changed our view in terms of our expectation of the Fed. I mean, we are still anticipating the first cut to be in May, and we expect probably about 100 basis points of cuts throughout 2024. And one of the things that we had pointed out when we were heading into this year, particularly given the rally in November, December, and the repricing of the marketplace of numerous rate cuts, that you'd see this volatility, right, as a market corrected. Well, Anthony, in the mid-January, the market was still pricing in 170, 175 basis points of cuts, and about an 80 to 85% expectation that it would be in March. We've pushed against that view, and now that, as you mentioned, the Fed meeting where Powell stated that more than likely there wouldn't be a March cut, I do want to point out in last night's 60 Minutes interview, he was asked that question, and he repeated it. So it's one of those situations where it just wasn't a miscommunication from Q&A. He actually said it again. So now what we have is a market that's really not only pushed out the first rate cut, but has lowered that rate cut by about 50 basis points. And what do I mean by that is now the market's pricing in about May or June timeframe, the same that we came in with. And just as I looked this morning, right before I got on trending, it was about 119 basis points of cut priced in. Again, 2 weeks ago, that was 175. So we're seeing this volatility within the marketplace as we would expect. So now, as the market starts to reprice that, less dovish overtone, yields rise. And, we've seen, and as you know, Anthony, we've had this sort of range in the 10-year yield, our expectation of 3 3/4 to 4 1/4. And in January, we saw a low of 380, like a high of 419. So it was actually a fairly volatile month, but we think that's going to continue, particularly as we have supply this month. But the more the market adjusts to the Fed and that Fed expectation, that lower the volatility will come.
Yeah, that's what I was going to say. A lot of times you get that kind of sell on the news, buy on the expectations, et cetera. But it looks like the when you look at yields right now, as I walked into the studio today to talk to you, Leslie, the 10-year was around a 415. So it's jumping up following, of course, what you just explained. Now the market is really pricing in what Powell's talking about. But I think the next part of that is talking about QT, quantitative tightening. And that's been a question in the press. Besides, when will the Fed start cutting rates? Is when will they start to slow down the quantitative tightening? But the start seems to be unclear. When do you think this is going to start, and what are some of the implications of that time frame to overall fixed income investments?
Well, the quantitative tightening has always been sort of like this back burner type of issue. I mean, Yellen used to describe it as watching paint dry. And, it hasn't really had this huge impact on the marketplace, but it has been one of the things that have drained liquidity out of the system on top of, historical rate hikes. So he didn't really mention much in the last meeting. We're waiting for the minutes. We're thinking that maybe in the March minutes he'll give a little bit more detail about quantitative tightening, but it's definitely on the forefront. So right now, if I had to say, our expectation would be that they'll talk about it in March, probably to start in mid-month. But again, it's going to be sort of this slow unwind, meaning that if you have a cap hypothetically of $60 billion a month in treasuries, he'll move that down, say to 40, and over the month it'll be gradual and it'll taper down, right? But one of the things that they really need to watch out for, we're in a very good situation where, listen, bank reserves are like $3.5 trillion. They're very ample right now. But as we've seen from history, sometimes they could adjust very quickly where they're not so ample. So I think that that's one of the reasons why they're really cautious about, putting quantitative tightening at least on the table. It maybe not be March, but we'll probably start in mid-year in our view.
Yeah,
once they start actually cutting rates.
Right, exactly. And just to put a little bit of an explanation on that to our audience, the Fed has already shed more than $1 trillion assets since last year. off the balance sheet. So what we're talking about here is how much more will they take off the balance sheet before what we call quantitative tightening ends. So just wanted to clear that up for the audience. And then that we'll be watching as well to see if there's any kind of comment from Fed Chair Jay Powell or the rest of the FOMC and their statements in minutes, et cetera. So Leslie, just kind of now let's talk about performance here. We're talking about fixed income. We've already mentioned that yields since the Fed meeting have gone up quite a bit. So overall, how did fixed income perform, and what were some of the surprises that came that maybe might shift your allocation, CIO's allocation, going forward?
Well, when we think about our allocation, it's not necessarily that we're shifting our allocation going forward because our belief is still, whether it's May or June, the Fed is going to cut, right? But this cut is accommodative, right? It's more maintenance. It's not something that puts a lot of liquidity into the system. So we do think that interest rates are going to go down the second half of the year. But one of the things that we noted when we entered the year, particularly given the fact we had a 373, 375 and 10-year yield in December, was that volatility would likely pick up in the first quarter. And because of that volatility, sectors that have a high correlation to the treasury market, whether it's munis, agency mortgage-backed securities, will probably face headwinds as interest rates have gone up. And that's kind of what we've seen. This has not been anything material. We saw spreads widen on the credit side the last week of the month, but this, in my opinion, is really a healthy correction. And it's not, I wouldn't even call it a correction. I mean, it wasn't anything that was any material move. And I do think that the market should still probably widen out a little bit in this first quarter. But the more time that passes and the more the market and the Fed converge together, then that volatility will start to subside. And unless we have some sort of scare of reflation due to geopolitical risk or housing, or in fact, we have growth that in the first quarter of 24 is either well above or well below expectation, then you're going to see this continued decline in volatility. But we're still looking for these higher quality assets to earn that carry, not necessarily from a tremendous amount of spread compression, but we want to earn that income. We want to earn that price appreciation as yields go down. And when the lower credit quality sectors start to widen out after an incredibly strong 23, particularly the last 2 months of the year, then we'll opportunistically get involved in those if, in fact, the economy supports that. But right now, we still like, agency MBS, and I know this chart you're showing here, which is perfect. This is a AAA asset class that not only has tremendous amount of liquidity, by the way, when you're really towards that end of the cycle, but you could also pick up yield and spread from a triple B investment grade corporates. That doesn't happen very often. And these spreads in agency mortgage-backed securities are well above their historic average. And this really has been because of a, technical headwind, not a fundamental headwind. We just need interest rate volatility to subside a little bit. We do think it will as the year progresses. But right now, you might have these little pockets of vulnerability.
And just to kind of wrap up and put a bow on this today, Leslie, as we know, our here at UBS, the CIO expects a soft landing from the Fed this year. Given that, for investors, what are the short and long-term, pieces of outlook that might affect their fixed income investment portfolios, given what we know and where we're expecting the economy to go?
Well, listen, we always talk about, people always ask about cash and when to invest cash. Listen, there's no question. Cash earned a seat at the table these past year and a half. There's absolutely no question given the yields they've had and given the fact we've had an inverted yield curve for such a long period of time. But I do think the forward outlook for cash, although you should always keep amount that fits your liquidity needs, but the forward outlook of cash is going to be, as we know, cash historically, and it's going to be based on capital preservation, liquidity, and yield. But that yield is going to be the third component, not the first. And what we're going to see as we move on with the year and that market starts and the Fed starts to cut, the fixed income market's going to push forward those 2025 cuts, and that 2-year yield's going to come down quite a bit. So we do think there's reinvestment risk there, and we do think the yield curve will be upward sloping into the latter part of the year. That's why we still like things like investment grade corporates, mortgage-backed securities. We love the 5-year area of the yield curve. That's where you want to play it. I mean, this past week and a half, we had a bit of what I call a bellyache because the 5-year underperformed given the repricing. But going forward, now that we've converged a lot more, the market and the Fed guidance, we do think that 5-year part of the curve will outperform.
Excellent. Leslie, always perfect with you as always. Great to see you, and thanks for stopping by.
Thank you.
Good. See you soon. And for more information from Leslie and the rest of the Chief Investment Office, visit ubs.com/views. That is our Insights website. Lots of great information for you up there. Plus, you can follow us on social media. We're on all the major platforms, including Instagram. That's our dedicated @UBS Trending channel for content you're not going to find anywhere else from the studio. And if you have any questions about your portfolio or anything that Leslie and I talked about today, make sure you are connecting with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, and remember to keep your eyes on what's trending. See you soon, everybody.